Over the past 60 years, historical data suggests that when the Federal Reserve decides to pause raising interest rates, the stock market tends to experience an average increase of 6% over the following 3 months. This statistical trend might lead one to believe that a Fed pause is generally positive for stocks. However, it's important to note that these figures represent averages, and there have been instances, such as in 1969, 1973, and 1981, where the stock market actually declined by an average of 6.5% in the 3 months following a pause. It's worth considering that the 3-month period immediately after the pause does not necessarily represent the market bottom. Therefore, even though a 6.5% drop may not sound overly concerning, it's essential to understand that it pertains only to the initial 3 months after the pause. Looking ahead, if the Federal Reserve were to pause on June 14th, it remains uncertain whether we would witness a market increase closer to the historical average of 6% or a decline. Predicting the specific outcome would require considering current market conditions and how they align with previous instances of similar circumstances. It is important to acknowledge that predicting the stock market's reaction to a Federal Reserve pause is challenging, as no one possesses a definitive forecast. Hence, our responsibility lies in conducting thorough research to determine the most probable outcome. So, how might the stock market behave in response? Let's consider the broader narrative. Eventually, the Federal Reserve will inevitably reach a point where a pause becomes necessary. During periods of low inflation, the Fed can initiate interest rate cuts sooner, bypassing the detrimental effects of a high interest rate environment on the economy. This accelerated transition to an easy monetary policy tends to elicit positive reactions from financial markets, leading to a 6% increase in stock prices. Conversely, when faced with high inflation, the Federal Reserve must maintain higher interest rates for an extended period. This prolonged period of elevated interest rates tends to impede economic growth, reduce corporate profits, and exert downward pressure onto the stock market. Given the current context of high inflation, it becomes evident that the Fed may have to sustain higher interest rates for a while, potentially leading to a more challenging environment for the stock market. Therefore, interpretations of the data may vary, but it is essential to be aware of the historical averages suggesting a stock market increase for 3 months after a pause, as well as the possibility of the stock market declining based on analogous scenarios. Ultimately, drawing conclusions from the available data allows for informed expectations regarding stock market behavior after a Federal Reserve pause. To ensure clarity, let's address the distinction between a Federal Reserve pause and a Federal Reserve pivot. A pause refers to when the Fed halts its interest rate hikes, while a pivot occurs when the Fed begins cutting interest rates. When examining historical data, it reveals that during the first interest rate cuts by the Federal Reserve, the stock market has fallen in 7 out of 9 instances, reaching a new low in that particular economic cycle. On average, in those 7 instances, the stock market has experienced a decline of approximately 23% from the final rate hike. However, it's important to note that these figures represent averages and the actual performance can vary. There were 2 exceptions in this trend, occurring in 1989 and 1995. In both cases, inflation was within the 2 to 3% range, and the overall economy was performing well. In such circumstances, the stock market did not fall following the rate cuts. However, it is crucial to recognize that our current economic landscape differs from that of 1989 or 1995, as GDP is trending downward and inflation is above 3%. Furthermore, a key indicator to consider is the yield curve. In 1989 and 1995, the yield curves were normal, reflecting positive market sentiment. In contrast, our yield curves are currently inverted, indicating a potential economic downturn. Having presented both sides of the story regarding Fed pauses and pivots, it is now possible to form your own opinion on the matter. However, the upcoming FOMC, Federal Open Market Committee, meeting will provide further insight into whether the Fed will pause on June 14th or take a different course of action. Before delving into the recent statements from central bankers, let's quickly review the events of the past 14 months. During this period, the Federal Reserve has implemented 10 consecutive interest rate hikes, resulting in a total increase of 5%. Currently, the Fed funds rate stands at 5.25%. The upcoming Federal Reserve FOMC meeting, scheduled to conclude on June 14th, prompts the question of whether they will opt to pause and maintain the interest rate at 5.25% or proceed with another quarter-point hike, raising it to 5.5%. Now let's shift our focus to the perspectives expressed by central bankers and their recent statements. Recent statements from central bankers, particularly from Powell, indicate a leaning towards a pause in interest rate hikes. During a Fed conference, Powell expressed the view that current interest rates are sufficiently high to limit borrowing, spending, and economic growth. He emphasized the importance of carefully assessing the data before making any further decisions. Powell's comfort with a pause stems from the recognition of the lag effect, wherein the consequences of interest rate hikes take time to manifest in the economy. The available data supports the notion of an economic slowdown. For example, the latest GDP report revealed a significant decrease, falling well below expectations. Powell's consideration of a pause reflects his intention to avoid exacerbating the damage and to prevent a more severe recession than necessary. Overall, Powell's statement suggests a cautious approach, taking into account the lag effect and the need for careful assessment before determining the next course of action regarding interest rates. On Monday, Raphael Bostic, the Federal Reserve Bank president of Atlanta, made a statement emphasizing the lag effect of their policies. He indicated that he would be comfortable with a wait-and-see approach, suggesting the need to observe how things unfold before making any immediate decisions. It's important to note that the term HOP has emerged in discussions regarding the Fed's potential actions. This concept refers to a specific scenario that may occur if the Fed decides to pause in June but later realizes that inflation is resurfacing. In such a case, they would need to resume raising interest rates, possibly as early as July or September. This particular scenario, where a pause is followed by subsequent interest rate hikes, is being referred to as a HOP. Therefore, the Federal Reserve currently has three options: pause, pivot, i.e. cut interest rates, or HOP, which is a pause followed by further rate hikes. It's uncertain whether the June 14th meeting will result in a pause or a HOP, as the final decision will depend on the assessment of data and evolving economic conditions. The Fed Bank president of St. Louis, James Bullard, is advocating for a HOP scenario, where he anticipates 2 more interest rate increases this year due to persistent inflation exceeding targets. Bullard emphasizes the need for timely action to address the situation. On the other hand, the Fed Bank president of Minneapolis, Neil Kashkari, suggests that even if they pause in June, it does not signal the end of their tightening cycle. He clarifies that the pause would allow for gathering more information. It is crucial to understand the purpose behind the series of interest rate increases, which is to slow down the economy and curb inflation. However, it's worth noting that the actions of banks play a significant role in this process. If banks tighten credit or reduce its availability, it can have a similar effect of slowing the economy and inflation. This consideration is vital, as highlighted by Federal Reserve Chair Jerome Powell, who acknowledged that stress in the banking sector could potentially mitigate the need for aggressive interest rate policies. Mary Daly, the Fed Bank president of San Francisco, further emphasizes that tighter credit conditions implemented by banks can be equivalent to 1 or 2 interest rate hikes. This underscores the importance of monitoring the health of banks and the flow of credit as significant variables in the overall economic landscape. With these perspectives in mind, it is essential to keep these factors and considerations in the background when anticipating the outcome of the FOMC meeting on June 14. If the Federal Reserve refrains from raising interest rates, it may result in a pause rather than a HOP scenario. This is because tighter credit conditions, which can be equivalent to interest rate increases, may naturally occur. The Fed aims to avoid triggering a more severe recession than necessary and intends to monitor how credit conditions unfold. It's worth noting that some Fed districts, such as Atlanta and Chicago, have not observed a slowdown in credit flow. However, other districts have reported slower credit flow. The importance of credit flow lies in its influence on Fed pivots, which occur when the Federal Reserve starts cutting interest rates. Currently, the probability of an interest rate cut in September stands at around 20%, down from the previous estimate of 40%. This suggests that the market is taking Powell's statement seriously regarding no interest rate cuts in 2023. However, full credibility is still not attributed to Powell by the market, as the expectation of interest rate cuts has been pushed back to November instead of earlier in the year. It was previously suggested that the market's expectations on Fed pivot were premature and overly aggressive, and recent developments seem to support this view.